Is a housing market crash on the horizon? Is a question that many people are left pondering as the housing industry in the United States navigates through the complexity of the year 2024. Even though the market is experiencing difficulties, such as rising property prices, high mortgage rates, and affordability issues, experts believe that a full-blown crisis, such as the collapse that occurred in 2008, is unlikely to occur. When it comes to preventing a big economic slump, the most important criteria include a large shortage of home supply, stricter lending standards, and persistent buyer demand, particularly in metropolitan markets that are highly competitive. The market, on the other hand, is susceptible to experiencing a slowdown or correction due to the combination of high cost and short inventory, particularly in the event that economic conditions continue to deteriorate. Despite the fact that a crash appears to be unlikely, the current environment indicates that there will be continued volatility, which may put the resilience of home buyers and investors alike to the test. Number 4. Supply constraints, a major factor in market stability. One of the most significant things that is preventing the housing market from imploding is the continuing paucity of homes that are available for purchase. The United States of America is now experiencing a significant housing crisis, with estimates saying that there is a shortfall of up to 6.5 million dwellings and that the deficit is expected to continue. This gap is the result of a number of factors, including the construction of new homes moving at a slower pace than anticipated, the unwillingness of homeowners to sell their homes due to the low mortgage rates they are locked into, and the demolition of older homes that are no longer viable. All of these factors have contributed to the gap. Home prices are being supported by robust demand, particularly from first-time buyers, in places where supply continues to be scarce. This interest is particularly prevalent in first-time buyers. Many people who are considering purchasing a home, particularly those who are attempting to get away from the high expense of renting, continue to force themselves into the market, which results in intense competition for the properties that are now available. Despite the fact that mortgage rates have experienced an increase and are currently hovering around 7%, this is the situation that has arisen. In the absence of either a significant increase in the construction of new homes or a shift in the equilibrium between supply and demand, it is highly implausible that housing prices will undergo significant decreases. This is because both of these factors are necessary for stability. Number 3. Economic stability and mortgage market differences. There is a big difference between the conditions that led to the home market meltdown in 2008 and the present market ones. During that time period, subprime loans and other hazardous mortgage products, along with speculative purchasing, contributed to the creation of an unsustainable housing bubble. Both buyers and lenders took on unnecessary risks, and many people bought homes with the expectation that prices would continue to rise indefinitely because of the market. Today's lending criteria are significantly more stringent than they were in the past. Banks now require comprehensive credit checks, greater down payments, and verification of stable income, which makes it more challenging for high-risk borrowers to obtain loans. In addition, the recent increases in interest rates implemented by the Federal Reserve have contributed to the reduction of speculative buying by increasing the cost of borrowing money. Additionally, these higher rates discourage irresponsible borrowing, which in turn reduces the likelihood of an unsustainable market bubble occurring. Mortgages have become less affordable as a result of these increased rates. Even if the housing market is experiencing difficulties, such as high prices and a lack of inventory, the regulatory and financial measures that have been implemented have resulted in a greater degree of stability as compared to the period leading up to the collapse that occurred in 2008. Number 2. Affordability crisis and shifting buyer behavior. Affordability continues to be one of the most significant worries in the housing market, despite the fact that there is a limited quantity of homes available. Home prices have increased by more than 40% since the year 2020, which has significantly outpaced salary growth and caused many people who were considering purchasing a home to withdraw from the market. Because of this spike, becoming a homeowner has become extraordinarily difficult for a great number of people, particularly first-time purchasers. However, despite the limited availability of reasonably priced rental options, a significant number of people are still attempting to purchase homes, particularly in big metropolitan regions. Buyers are driven to take action as a result of the fact that purchasing a home has become more affordable than renting in a number of the largest cities in the United States. This further puts pressure on the market. It is also true that the combination of high property prices and rising mortgage rates has resulted in a slower turnover in the market. This is due to the fact that many homeowners who are currently in their homes and have low mortgage rates are hesitant to move. Another factor that has contributed to the worsening of the housing supply crisis is the decrease in home sales. Although there has been a slight decrease in demand due to factors such as affordability, the level of competition for the limited number of homes that are now available has remained high, which has prevented a large decrease in home prices. As a result, despite the fact that affordability problems continue to exist, the general mismatch between supply and demand prevents prices from falling significantly. Number 1. What could trigger a downturn? Several factors have the potential to either produce a minor slump in the housing market or to slow down the market overall. To begin, an increase in the unemployment rate may have a significant impact on the number of purchasers in the market. If economic conditions continue to deteriorate, for example, as a result of a recession or financial instability, a greater number of individuals may lose their employment or see a reduction in their salaries, which will restrict their capacity to finance homes. The drop in the number of prospective buyers may result in a decline in the pricing of homes. This is because sellers may be required to cut their asking prices in order to attract the smaller pool of buyers, which may result in a price correction. Second, a significant rise in mortgage rates might make affordability problems much more severe. In the event that the Federal Reserve or other economic pressures were to push mortgage rates even higher than the current levels of 7%, the monthly cost of home ownership would increase, which would cause a significant number of potential purchasers to withdraw from the market. This has the potential to dramatically reduce demand, which might result in a plateau or drop in housing prices. This is because fewer people will be able to afford homes at higher rates, particularly in places that are already struggling with affordability. Last but not least, the actions of institutional investors are still another element that has the potential to shake up the housing market. Over the past few years, large investment corporations have been purchasing residential homes at an increasing rate, particularly in locations that are in high demand. This has resulted in rivalry between institutional purchasers and average home buyers, which has the potential to drive up prices and generate a speculative bubble. The presence of such market distortions may cause prices to temporarily rise above levels that are sustainable. In the event that these investors withdraw their investments or the market makes adjustments, it may result in a price correction in such regions. Conclusion: while concerns about a housing market crash are understandable given current economic conditions, a full-scale collapse similar to 2008 seems unlikely. Factors such as a persistent housing supply shortage, stricter lending standards, and strong demand, especially from first-time buyers, are preventing a major downturn. Although rising mortgage rates have made homeownership more expensive and dampened affordability, they also help curb speculative behavior, which has historically fueled market bubbles. Additionally, the lack of available homes continues to prop up prices, particularly in areas with high demand. While the market may face slower growth or moderate price corrections due to affordability challenges, the conditions today, marked by tighter financial regulations and limited housing inventory, make a crash unlikely. However, the market will likely remain volatile with regional fluctuations and price adjustments as economic and interest rate changes unfold. Thanks for watching and subscribing channel.